What shaped markets today wasn't just price action, it was a fundamental shift in expectations around global energy security and the inflation fall. We began the month of March in a state of high alert. While the headline indices looked deceptively calm with the S&P 500 and Nasdaq essentially flat, the underlying move was a violent decoupling of asset classes. The real story was in the safety trade. We saw a massive surge in the 10-year Treasury yield, which jumped over 2% to cross the 4.0 threshold. Simultaneously, crude oil exploded nearly 6% higher and gold hit a record $5,336. When yields and commodities spike together like this, it tells us the market is bracing for a significant inflationary shock. The primary trigger was a massive escalation in the Middle East over the weekend. With direct kinetic conflict now affecting the Strait of Hormuz, the market has moved from a soft landing narrative to a supply-side shock reality. Roughly 20% of global oil shipments are now at risk, and investors are reacting to the possibility of a prolonged blockade. But it wasn't just geopolitics. New manufacturing data showed that prices paid by businesses are at their highest level in nearly 4 years. This suggests that even before the weekend's events, inflation was proving to be much stickier than hoped. On the corporate front, we're seeing a flight to defense-linked tech. Palantir jumped on news of surging demand for intelligent software, signaling that in a high-conflict world, government spending, not consumer apps, is becoming the primary engine for software growth if we look at where the money is moving. Institutional investors are executing a wartime rotation. Capital is clustering into energy and industrials, specifically defense. Meanwhile, the sectors we rely on for everyday life, like consumer staples and discretionary, are being actively abandoned. The most interesting move, however, is in the alternative safety space. Bitcoin and gold both surged together. This suggests that institutions are increasingly viewing digital gold as a legitimate hedge against geopolitical instability, moving it more like a hard asset than a speculative tech stock. The psychology here is clear. The market is positioning for supply-side stagflation, where raw materials and defense are the only reliable ports in the storm. Beneath this rotation lies a structural risk that is currently under-discussed: the liquidity vacuum in global shipping. With major shipping routes effectively frozen, the debt tied to those vessels and their cargo is also becoming locked. If this blockade persists, we could see credit defaults in the financial sector that are not yet reflected in bank stock prices. The market is currently operating on the assumption of a short conflict, leaving it vulnerable if the situation remains unresolved. Today represents a medium-term regime shift. We have moved from a market focused on the timing of Fed rate cuts to a market focused on physical scarcity. The debate is no longer about when rates will fall, but how high they must stay to contain this energy shock. For investors, this signals that the old percent inflation target may no longer be a realistic anchor for the current era. The next major test arrives this Friday with the February jobs report. It has shifted from a routine update to a massive narrative shifter. If the labor market remains hot despite these global shocks, the Fed may be forced to consider rate hikes, a scenario the market currently views as impossible. We are also watching the transport and airline sectors closely. They are the front line for how much energy tax the American consumer can actually withstand before breaking. The soft landing playbook has been sidelined. What this suggests for investors is a pivot toward hard assets and sovereign scale technology, as the market begins to prioritize physical security and supply chain resilience over traditional growth multiples.